Joining us for way too short a visit, William Lee is chief economist at the Milken Institute. He's been incredibly busy. Bill, I'm going to pull an audible on you with all your IMF work over the years in the Pacific Rim. People are focused on China. People are focused on Canada. People are focused on Mexico. I'm focused on over 1 million unit exports of Toyotas from Japan. We had a negative real GDP today. We got a 40-year bond yield in Japan that's to the moon. There's a huge tension there politically as well. Explain the importance and power of Japan in these trade negotiations with Mr. Trump.
Well, you saw what the UK did for creating a template as far as how partnerships work with the United States, right? That's an example where you had a lot of investment in the United States by the UK, and there's reciprocal understanding that there's Boeing buys Rolls-Royce engines, and then they buy back the Boeing plane. There's no tariffs on that kind of partnership relationship. Japan is one of these, also the great partners of the United States. Japan has one of the largest net investment positions in the United States, and I think the template that we're going to see coming out of the trade agreements is again an example of what good partnerships are. And now China, right, is the good example of what President Trump calls competition with the U.S. He chooses not to produce here, he chooses not to invest here, and you have a tariff wall. And I think that's going to be the template that we see going on to the rest of the deals that we will be making.
With all of your experience, is the 10% a firm wall of tariffs, or could the tariffs dip below on a blended basis and migrate back towards that 3% level?
You know, I think one of the best things that happened to markets was when Secretary Bessent talked at the Milken Conference last week and reminded everyone tariffs are just one part of a policy package of smaller government, lower taxes, fewer regulation. That's the important. Those are the important ingredients. The tariffs are really a small piece that tells our investment partners, look, you come here to the United States, we'll give you a tariff wall to protect your investments from unfair competition. So I think the 10% number is there to stay, to remind everybody the value of the access into the U.S. marketplace and to get rid of any kind of unfair competition. So I think the tariff walls will stay with us. I think it'll be at that 10% level. But again, it's a small piece of the policy package that really is exciting markets and reminded markets that that's where the emphasis is on the policy front.
Bill, what do you make of the weakness in the U.S. dollar here? We've seen other risk assets like stocks rebound and retrace much of the losses, but not so much the dollar. What do you make of it here?
I'm so glad you asked that question, Paul. Again, that was a major part of the discussion among every major investor at the Milken Conference. And they were always saying, what's happening to the role of the dollar and its valuation? And I think that's the key difference. The valuation of the dollar has come down off of its peak back in February when everyone was so enthusiastic about the Trump election. Let's remember that the value of the dollar is well above where it was 5 years ago, for an average for the last 5 years. But the role of the dollar has really not changed at all. The role of the dollar as a reserve currency, the role of the dollar as the vehicle currency, that is not changed, and no one has even talked about finding substitutes. But the valuation moves around, and it's come off of the all-time highs, and that's normalization is right.
We continue with Bill Lee of the Milken Institute. Why don't you continue with Bill Lee?
Hey, Bill, a lot of folks, when they think about tariffs, they say they are a tax on the consumer. They say they are inflationary. Do you agree?
You know, Paul, every economist is trained to say tariffs are the creation of the devil. It's the worst thing you can do to an economy. And I think in most cases it is. And it's been used badly by most emerging market countries to try to protect failing industries. I remind you that when a doctor diagnoses you with atrial fibrillation, he gives you Coumadin or warfarin, which is rat poison. And I think that there's a role for rat poison as a package of therapies. There's a role for tariffs as a package of economic policies. In this case, the role of tariffs is not to protect industries, but rather to incentivize serious discussion about bringing capital into the United States. And that, I think, was the real role for the tariffs. That again, President Trump has reminded everybody that we really need to reshape the global economic trading system, and we can't live with the WTO system that was created after World War II.
Billy, you and I read Ricardo cover to cover. He didn't deal with the service sector like we have now. Do tariff outcomes, are they the same in a service sector as a goods producing sector? I don't buy it.
It's pretty hard to tariff services, isn't it? Especially when it's a license for American banks to sell financial products in China. So I think the whole notion of tariffs has been done away with, especially with the different rounds of tariff reductions we've had over many decades. But the real serious barriers to trade that Ricardo didn't deal with are non-tariff barriers and the legal requirements and health requirements and quality standards that are demanded of U.S. Exports into various countries. Those are the obstacles that are part of the negotiation package that President Trump wanted to incentivize by putting up this huge tariff barrier and say, look, you guys, let's get serious about getting rid of the real serious blocks to trade.
Way too short a visit. Bill Lee, thank you so much. Greatly appreciate it. With Milken here, off of the Milken Institute celebration of another week's ago. Shally Bassick, thank you so much for Milken coverage. The chief economist, the Milken Institute.